After Mohnish Pabrai studied what the best investors' mistakes were, he came to the following three things. So the first one is leverage, and leverage seems pretty obvious on the surface, but the thing about it is that even if you have a great quality business model, if there's any slight downturn or any unexpected delay or anything unexpected, which in business and in the world, in fact, more than not, there is often something unexpected that comes up. The business could face serious risk of bankruptcy or just becoming worth a fraction of its price by maybe having to dilute shareholders significantly to raise capital, etc. I've got a couple examples of this. So this is actually an investment that Mohnish Pabrai made himself, Horsehead Holdings, a few years back. And effectively, they were a zinc recycling plant. It was quite an attractive valuation, but the issue with the position was that there was just a significant amount of debt there. And essentially what ended up happening, again, you could have said it was unforeseen, but I mean, to be honest, I think you should always price in the fact that something unforeseen is going to occur, particularly when you have a lot of debt. And what ended up happening was that they were building new facilities, they raised a lot of debt. To do that, there was delays in their new facilities, and then within that time, zinc prices coincided to fall relatively significantly, and that meant that the business just couldn't fulfill on its debt obligations, and as a result, the business went bankrupt. Mohnish Pabrai lost a very significant position. I think he went bank. I think he lost the entire position there, if I'm correct. So that's the first one. It's leveraged, and generally the most common. Second is equally common, and that's sort of management and the ownership sort of structure there. And there's a few sort of stories I can pull. I think more recent examples in Ukraine have been quite interesting for myself. A good example, a famous example actually in Ukraine, if anyone's been following the Ukraine markets, is a business called Kernel. And essentially what happened is the business was worth a fraction of its price once the war was announced, sort of mid-war. And essentially what happened is you had a major shareholder previously, and this shareholder essentially controlled and took his control and took advantage of the situation. And when he knew the stock was significantly undervalued, he basically forced a buyout to occur. And you might have said, well, you know, that could be a win because at least you're going to get a bit of money back with that premium that's going to get sold out. Well, not really. It got forced to sell at a 2% premium to the listing price, which isn't really anything, particularly when everyone knows that this company is massively undervalued and it's just because of the war ongoing, and actually the underlying business hasn't been impacted as such, particularly when large portions of the business could operate outside of the targeted areas. And as a result, you know, you had shareholders who had owned a seemingly reliable business. Yes, it was during a war, but you know, the fundamentals business still stood there and it was highly undervalued. But again, you had sort of ownership structure there issues, and it's more of an ethical issue as well, where his incentives were aligned differently from the rest of the shareholders to where he wanted to take advantage of the company. And now fast forward 2 years, I think you had like a minority amount of the shareholders, like 4 or 5% of the shareholders, basically refusing to collaborate, and I mean rightly so, with the situation that's gone on, and taking him to court is now being reviewed by, I believe, the Warsaw Stock Exchange, but also regulators in either Ukraine or Netherlands. I forget off the top of my head, and it's just dragged out now for ages, and you know, that's not a result for anyone there, is it? It seemed like a perfectly good opportunity for common stockholders, and yet it was destroyed by like that. I've got a few other examples I can rattle off the top of my head without going too long. Another example is MHP. Though this seems like a small sort of issue at the time, MHP has a large shareholder, the CEO who runs the business, and effectively, you might not agree with this, but to me, I see this as a large red flag, which is the fact that you have a large shareholder who's effectively treating this company as his personal piggy bank, which, you know, if you fully own the business, then fair enough, it's your business, do whatever you want, but you're not really treating the other shareholders fairly. And what I mean by that is that he basically took out $100 million loan when, again, this business is only producing, like, I don't know, 90, $100 million a year when you account for all the inflation costs and the currency devaluation costs on their debt. And what he did with this 100 million is basically it was undisclosed. The interest rate he didn't know, the what it was purpose for, but I think there was the large speculation that it was basically to fund his own yacht. And rather than giving him that $100 million, an undisclosed interest rate, it could have been used to pay off any debt they have in US dollars and euros. And the reason why that's so important, you might think under normal circumstances, well, you know, if you pay off $100 million of debt, that you know, you're only really going to save 4 or 5% on the interest, which, you know, $4 to $5 million is still quite a bit considering their net income's 100 million. But you say, well, you know, the company's cheap enough, so even though if there is that small issue that could be a problem, well, actually, it's not as simple as that, because A, it shows that if that's happening pretty publicly, then what else could be happening that's not public? Secondly, and I think this is the more important thing for me here, is that, well, actually, you're wrong with that initial calculation, because a lot of their working capital is in sort of the Ukrainian currency, especially during the war. It's sort of been restricted for the company to be able to extract their cash and keep it in a different reserve currency, because they're not allowed to. And what this means is actually, because the currency's been devaluing by 15% on average every year for like the last few years now, is that not only are you paying the interest of 5%, you're also paying 15% on devaluation, which is like a hidden tax, but really it's still there, because at the end of the day, it's still going to affect your P&L. And what that means is, had the business paid off debts quicker, and actually had they paid off debt at a quicker rate, and actually had that money no longer owed, like that smaller amount, that would basically mean that the business would take a lot less in losses. So on that 100 million, they could have made or saved themselves potentially like $15 million, which is, you know, 15% of their net income. That is huge. And that's just like one small example. There's plenty of examples if you just look at Greek shipping operators, where they dilute the heck out of their own company and then snap it up at dirt cheap valuations and take it private. That's another one. There's plenty of those in the Greek shipping space. So if you want to do some digging, go do some digging there. And yeah, so management and ownership are often a very big concern. What's the share type structure? Do a minority control the voting rights? Does a significant shareholder have, you know, power to outvote anyone? Does management have a track record of fraud or potentially shady dealings? That's something you all need to take into account. So we've been over the first, which is leverage. Second is management and ownership. And the third is the moat, or the competitive advantage, and mainly misunderstanding or not misunderstanding the moat or overestimating the moat. And this is something that Lee Lu actually talks about as well, another sort of Buffett Munger disciple, who's, you know, done phenomenally well for himself. He's done 30% a year for the last 20 years, which is just ridiculous. And a really good example of this was actually Warren Buffett's Dexter shoes, where he bought this company actually with Berkshire stock, so even more expensive now when you think how much Berkshire's gone up. But effectively, what Buffett didn't quite understand is how, yes, Dexter Shoes was maybe a low-cost provider, but he didn't understand how the moat was significantly weaker than he thought when he took into account that foreign producers of shoes are able to get a much more attractive rate by using that labor arbitrage, where, you know, the minimum wage in a different country is going to be lower, and therefore they can and their natural resources might come in at a cheaper price, meaning that they can import those same type of shoes at a significantly better rate. And Dexter Shoes doesn't really have anywhere it can stand on, because it doesn't really have a brand when you consider the fact that it's in that low price category, or no pricing power behind that brand. And equally, it doesn't have the cost advantage either, because it's not the lowest cost producer, which can be a moat in itself, but you have to be rock solid certain that is actually the case. So I think a lot of the time the risk can come from underestimating the moat, or just simply, overestimating the moat, or simply not seeing the flaws in your logic, and the reasoning behind that. And that can be quite a common one. Again, it's quite hard to tell. I mean, none of these are straightforward to tell, but I think if you're at least conscious, aware of them, and you build systems around them, and what I mean by that is you might have a checklist, you might ask yourself questions, and just keep constantly sort of look out for that, then at least hopefully that, for me anyway, is going to help me sort of prevent any mistakes that I could potentially be making, that, you know, these world's best investors are making. So if I can at least do some of the things that they're not doing, that will help me significantly. Hope you found value in that.